What's up everybody, Nate here. So stocks in 2022 have just been on the worst roller coaster ride. Kind of like me riding Space Mountain back when I was a kid. Yeah, I definitely wasn't okay. But the big difference is I'm okay today, but the stock market definitely isn't. So the stock market so far in 2022 has done nothing but drop all of its gains that it's grown over the last couple of years. It hit record highs back at the end of 2021, but now it's nearly erased all of them. And it got so bad that the stock market actually went into bear territory for a short time in 2022. Many Americans and investors were hoping that this was going to be the absolute bottom of the stock market, meaning it wasn't going to go any further downward. But unfortunately, legendary investor and economist Ray Dalio believes that the stock market is about to fall even more. Ray Dalio believes that the stock market could end up falling by around 20% because of all of the Federal Reserve's interest rate hikes. And that means that the stock market is about to go on an even worse roller coaster ride than I had at Space Mountain. So today I want to talk about Ray Dalio's thoughts on the stock market and where it might be headed next, and I want to kind of break down what he means and how all of this is going to play out in 2022 and next year. Alright, so the key things that you need to keep in mind is that the stock market has been falling for a very long time now, but over the last, I would say, month or so, it's actually started to rebound slightly coming out of its bear market territory. Now look, we are still in a pretty big stock market sell-off as investors are really unsure about our economy and they're really unsure about how inflation is going to affect everything in 2023. So that is why we're still seeing a big sell-off. Just because it's not in a bear market doesn't mean that it's in a bull market. Right now, it's kind of in neutral territory. And the biggest reasons why the stock market has been falling has to do with inflation and the Federal Reserve. Now, the main two reasons why stocks have been falling is because of inflation and the Federal Reserve. The Federal Reserve has been raising interest rates, and Ray Dalio believes that, well, they might get way too aggressive, way too quickly, and that is going to eat up all equity prices. Now, to give you a little bit of backstory, the Federal Reserve has been raising interest rates all throughout 2022. They raised them by a 1/4 percentage point, they raised them by a 1/2 percentage point, and then a few times by 0.75 basis points. And that means that rates in the US are getting a whole lot higher, and people are having a really hard time borrowing money for businesses or just to get a home. In 2020 and in 2021, the Federal Reserve set their interest rates at around 0%. They wanted to incentivize borrowing and they wanted people to go out and spend a lot of money. So it was really easy for people to get a mortgage or an auto loan or to spend on credit cards because the interest rates were really low, and that meant that our economy was going to continue to survive because we didn't know what was going to happen with the pandemic, so we wanted to kind of incentivize that demand and bring it up so that way there was a whole bunch of spending. 70% of our GDP relies on consumer spending, so without it, your entire economy could crash. Not only that though, the Federal Reserve has been printing a ton of money with its quantitative easing program for Wall Street and printing money for the federal government with a whole bunch of stimulus programs, and that meant that spending was at an all-time high, but now everything is starting to reverse in 2022. The Federal Reserve has basically turned off the money printer, and so has the federal government, and its interest rates are actually starting to go way up. Currently, the federal funds rate is at around 2.25 to 2.5%. Now, this is considered neutral in the United States, and it's not really helping the economy to grow, but it's not sending the economy into a recession either, so everything is essentially neutral. However, Ray Dalio believes that interest rates could go up to around 4.5 to 6% by the end of next year, and that would essentially send the stock market into bear territory. But it would also mean that inflation most likely goes way down. So what exactly is happening here? Does the stock market not actually want to see inflation go down? Well, kinda. So you gotta remember, the stock market is all about betting on the future of the United States economy, and in the short term, things are going to get pretty volatile depending on what actually happens in the United States economy and how people are actually spending. But when we talk about the future of the United States economy, that comes with growth, and the companies that are traded on the New York Stock Exchange want to see a lot of growth, and that involves profits and it involves revenue. But in order for these companies to actually make money, they need people to go out and spend money. And with interest rates going up, that immediately makes it a lot harder for people to spend money. Not only that, but inflation is a really big problem in the United States, as in August of this year, it was around 8.3% year over year. But there is another way for these companies to grow. They can actually get a lot of investor interest. This is one of the reasons why companies launch as an IPO IPO on Wall Street. They want to be a public company so that way people can, well, invest in their company, own shares, and then those companies can use this liquidity and capital to grow their business. They don't have to solely rely on sales anymore. What you have to ask yourself is, where do a lot of investors get their money to invest in companies? Well, a lot of investors use debt to invest in companies. This is a way for an investor to take on money for right now. Sure, they're going to have to pay that debt back, but if they invest in companies, they may end up making more money back, so that way they can actually make a profit from their investment. Many investors don't just have all of this money lying around. They borrow money so that way they can earn more money in the future, and that whole cycle kind of creates a lot of these businesses. But the problem is, in 2022, it's a lot harder for investors to borrow money, so they're just not doing it as often as they were over the last couple of years. As interest rates continue to get higher, well, that means this debt is going to get more expensive, and investors need to see a lot bigger of a return on their money. But the fact of the matter is they're just not going to see it with inflation being this high, because people are not buying as many things as they were before. So investors are pulling out of the stock market, and they're just kind of waiting because inflation really isn't coming down that quickly right now. So they don't want to invest all of this money just to lose it in the short term. That could jeopardize future deals as well. So investors just don't want to do it. This means that companies are losing out on a ton of money here. They're not getting that same amount of growth that they saw over the last couple of years, which is why the stock market boomed in 2021 and set new record highs. It was a really different time though, because the Federal Reserve was printing all of this money in their quantitative easing program. So they were pumping hundreds of billions of dollars every single month into the stock market in treasury notes and corporate bonds. These corporations could then invest and take equity in a lot of other companies, and investors now had a whole lot more money to invest in more companies. That pushed the stock market up to a new record high, on top of interest rates continuing to be at 0%. The Fed is slowly starting to pull back all of that money though, so as they do that, there's less money for investors to spend, and it's harder to take on that debt in 2022. So like I said before, investors are just avoiding it, and now companies are left with a situation where they don't have as much money from sales, profits are a lot lower, and they don't have that investor liquidity and capital anymore. So they start to fall, and when they start to fall, investors start to pull out. So that is in the short term, right? So we know that the Federal Reserve is raising its interest rates, and eventually it's going to have to stop raising its interest rates. It can't just keep them going forever. But right now the stock market is thinking about the future of our economy in general, because they know if the Fed continues to raise interest rates, well, that is not really going to have much of an effect on inflation. The Federal Reserve and Chairman of the Federal Reserve, Jerome Powell, actually admitted this just a few months ago. Their rate hikes are not going to bring down the price of food. They're not really going to bring down the price of energy anyway, so why exactly are they doing it? Federal Reserve is raising interest rates because they have to preserve the United States dollar as the world's reserve currency. Right now, there are countries all throughout the world, China as one of the biggest ones, holding on to a lot of US dollars and our debt. The problem is China recently has been unloading a lot of this US debt because the United States is facing a massive inflation problem. It basically works like this. Your money has a certain amount of value, and the only reason it has that value is because your country has a strong military and your country has a strong economy. But now the more money that you print, the value and the buying power of that money goes down. Think of it this way. If there was only $100 in the United States and you had $1, you would hold 1% of all of the wealth. But now if the Federal Reserve decides to print $100 more, you hold a lot less of the wealth. You now need $2 in order to buy what $1 could before. That is exactly what we're facing right now. As the Federal Reserve and the federal government prints a lot more money, well, now you need a whole lot more money in order to buy the same things, and your money becomes a lot less valuable. So in order to preserve our money, they don't want to print any more. They want us to basically use everything that they have, which means you're not going to grow your economy. Printing money isn't such a bad thing. You got to think, when we print money, the federal government doesn't just sit on that money. They use it to give to private contractors. They use it to pour back into banks and to our economy, so people can borrow more money, people can start more businesses, people can get paid a whole lot more, and that grows our economy even more. But it needs to be controlled. It can't be 8, 9, 10%. It can only be a little bit every so often. It's got to be controlled controlled growth. So we're always going to have inflation, but the problem is we can't have really high inflation, because if we do, the value goes down. So the Federal Reserve wants to make sure that that doesn't happen on the global stage, because now nobody's using our money, nobody wants it, and that's going to cause us a huge debt problem and could end up causing the US economy to collapse. But that is all in the long term. So in the short term, the Federal Reserve wants to keep something called price stability in our economy, and they don't want to have the price wage cycle kind of spiral out of control. Like I mentioned before, when you have a lot of price hikes, people can no longer afford to buy things anymore because, well, their wages and salaries haven't gone up. Businesses then have to give them raises. People can then go out and buy more, but as they buy more, companies have to produce more, because if they only made the same amount of products, then they would run out everywhere and they wouldn't really be making a lot more money, they'd just be running out. So businesses hire more people, they build more factories, and all of that comes at a cost, which then is trickled back down to the people. Prices go back up, and now people can't afford what they could before, and businesses have to give them a raise. This is a vicious cycle that can get out of control, and it means that inflation is going to continue to go up and go up. So the Federal Reserve, in short, wants to cut all of that off by raising their interest rates. They're bringing money out of circulation because people physically can't spend it because everything is way too expensive. You can't get a mortgage anymore because mortgage interest rates are getting way too high. That immediately disqualifies you for a certain mortgage, and same with an auto loan, and same with your credit card. Ray Dalio believes that inflation is going to continue to go up in our economy as well. So for the most part, a lot of investors believe that over the next 10 years, inflation will be at around 2 to maybe 3%. But he believes that inflation could stick around 4.5 to 5%, which means we're going to see an extended period where the Federal Reserve keeps interest rates high and the stock market goes way down. If interest rates do go that high, say around 5 to 6% from the Federal Reserve, businesses are no longer going to be getting any liquidity from investors because they don't want to put their money behind something that's not going to get them a big return. They're going to be losing a lot of money. And until inflation goes down to that target level of around 1 to 3%, the stock market is going to continue to drop. This is because they're looking towards the future here. And with the Federal Reserve raising interest rates this high, they know that this is going to cause massive unemployment. These businesses simply don't have the money or the capital to hold on to people, especially if profits continue to go down, and same with revenue. So they're going to try to minimize their costs as much as possible, making products and portions smaller, firing people, and doing whatever they can to, like I said, lower costs. All of that kind of builds on itself because now you have nobody pouring money into the stock market, people losing their jobs, and if people don't have a job, they can't exactly go out and buy anything, so businesses are again going to get hit even harder, and that is exactly what sends you into a recession, something that Ray Dalio believes is right around the corner. And that kind of trickles down into other aspects of our economy because now people think that the economy is going to be really bad, so they don't want to go out and buy things, so they start saving money. And when people start losing money in the markets, these banks and financial institutions have to be very careful with who they give loans to, meaning that interest rates get even higher and they bar out anybody that isn't pretty much a wealthy individual. And according to Ray Dalio, there really isn't anything else to do. The Federal Reserve has been too reactive to this problem and not proactive, so now they have to raise interest rates, but that's not really going to help because a lot of the factors that are affecting inflation are outside of the Federal Reserve's control. That's why raising interest rates isn't going to help them. It will only ultimately help indirectly because it's not going to directly bring down the prices of food and energy, but what it will cause is a lot of these businesses and companies to have a whole lot less money, and when they have a lot less money, they still try to make a profit by cutting costs, which means cutting a whole lot of their workforce, and with people out of a job, well, they're not going to be able to buy anything, meaning that inflation will come down because nobody is spending any money. And with that happening, earnings reports are going to be really bad, so now the stock market continues to drop because investors are getting scared even more. They don't want to invest in companies because these companies are not making any money. That's why Ray Dalio believes that the stock market has not reached its bottom just yet, and that it could actually fall a whole whole nother 20%. So with all of that being said, here is exactly what you need to know. The stock market is in a really bad spot right now. I'm sure I don't need to tell you that. And to be honest with you, the stock market is probably going to be in rough waters for the next year or so. But this is kind of a time for you to assess your goals. Are you in it for the short term or are you in it for the long term? If you're in it for the short term, then you're probably going to have to do a lot more analysis and kind of get down to fundamentals to figure out how you're going to be trading your stocks. You might have to figure out, well, should I invest in real estate? Should you invest in cryptocurrency or commodities or something else that is going to bring you money during this time when the stock market isn't a guaranteed bet? That's going to be rough, but there's always good investments out there, even if it's not exactly the easy money on the stock market anymore. But if you're in it for the long term, say you're holding on for the next 30 or 40 years, and to be honest with you, you don't really need to change your strategy at all right now, because it doesn't really matter what happens right now in the stock market or today. It only matters what the stock market looks like 30 and 40 years from now. That is something that Ray Dalio talks a lot about. Our entire economy and the stock market and pretty much every market on the planet goes through cycles, and it pretty much always has. You're going to have periods where there's a lot of economic activity, a lot of growth, and then you're going to have periods of massive sell-offs and recessions. This is just the way our economy works, and there's going to be booms and busts over time. We've had the stock market crash of 1929 and 1987 and 2020, but every single time the stock market has recovered, and there's no reason to stop believing that in 2022. More than likely, the stock market will go back up, and it might take a few years to get there. Eventually, though, the stock market will go right back up. It's just going to take time for everything to kind of settle out, and the reason being is because think of what the stock market is. It's publicly traded companies, and the reason the stock market is failing is not because of all of these companies, it's because of the Federal Reserve, and it's because of our economy. A lot of those factors investors and businesses have zero control over. So these are all good companies that eventually they're going to figure out how to stick around, and if you invest in them today, they're probably going to be around for the foreseeable future. I can't say that about every single company, but like I said, there are good investments out there, and holding on to these investments over time has proven to basically always be successful. So it really doesn't matter if the stock market drops by 20% or more right now. You don't even need to look at your portfolio. Just hold on and do what you're doing according to your goals. Like I said, hold on to things for the long term, and none of this will affect you today. And of course, the other key takeaway is to always do your own due diligence and research. Never blindly listen to anyone on the internet or of course on YouTube, because, well, they could be wrong. So you always want to make sure you're doing your research and staying up with the times, because things could definitely change. That's why I am putting out videos 7 days a week over on this channel. And if you want to see another video from me, I've got that right here. So be sure to check that out before you go. And if you want to stay up to date with all the top business and financial news, my team puts together a free daily newsletter, and you can subscribe to it by clicking the link in this corner right here. That is it for me, everybody. Be kind out there, and I'll see you all in the next one.